Welcome to the deep dive on Stock Talk. We are definitely hitting the ground running today.
Yeah, we are.
We're taking a close look at Canada Goose's fourth quarter and full year fiscal 2025 results. They just came out this morning, May 21st.
Exactly. We've sifted through the report, and, well, the plan is to pull out the really important bits for you.
Right, give you a clear picture of, how the company's doing and maybe where it's headed.
Precisely. Performance and outlook.
And hey, if this kind of deep dive is useful for you, please do subscribe, maybe give us a like, share it around.
Yeah, and comment. Let us know what you think.
Definitely. Okay, so Canada Goose, it looks like they ended the year with some real momentum.
They did, yeah.
Mm.
I mean, look, the full year revenue, it was up modestly, just 1.1%.
Yes.
That gets them to about $1.35 billion.
Okay.
But that fourth quarter really jumped out. Revenue climbed 7.4% compared to last year. $384.6 million for the quarter.
So a strong finish.
A very strong finish. Suggests a good upward trend going into the new fiscal year.
And beyond just the sales numbers, did they call out any specific wins, things they were happy about?
Oh, yeah, absolutely. They highlighted improvement in their own stores, their retail operations.
Okay.
Also pointed to the Snow Goose campaign, giving the brand a lift. And, importantly, a big drop in inventory.
How big a drop?
14% down year over year. And they made a point of saying that 6 quarters in a row they've cut inventory.
Wow, 6 quarters. That sounds like a much tighter management.
It really speaks to better operational control, yeah. Less stuff sitting around.
Okay, let's maybe zoom in on that Q4 revenue number then, that 7.4% growth. What was behind that?
Well, the report is pretty clear. It was overwhelmingly their direct-to-consumer channel, DTC.
Their own stores and website, basically.
Yeah, their DTC revenues surged 15.7% in Q4. That's $314.1 million.
15.7. That's quite a leap.
It is. And maybe even more telling, within that DTC channel, their comparable sales grew 6.8%.
So existing stores and online are selling more?
Precisely. It shows their own platforms are really connecting. That almost 16% jump isn't just noise. It signals, a real strategic shift working. More control, potentially better margins, too.
Right, more control over the experience, the data.
And all of that lets them react faster, tailor things better.
So, okay, more direct sales. How did that flow through to, their profitability? Did it help the margins?
Oh, significantly, yeah. Their gross margin in Q4 expanded quite a bit. It hit 71.3%.
71.3. And what was it before?
Last year, same quarter, it was 65.1%. So that's a, 6.2 percentage point increase?
That's a big jump in gross margin. Why such an increase?
2 main reasons they cited. First, they needed less money set aside for, potential unsold inventory. Those provisions were lower.
Because they managed inventory better.
Presumably, yes.
Yeah.
And second, just a bigger slice of the pie came from that higher margin DTC channel we just talked about.
Right. So sell more yourself, keep more of the profit.
That's the idea.
Yeah.
And a 6.2-point gain. That's substantial. It means more money dropping down before hitting other operating costs. Feeds right into the bottom line or allows for more investment.
So higher DTC, better margins. Sounds like the profits should look pretty good for Q4.
They did. Very good, actually. Operating income shot up 138.5%. That's to $55.1 million.
Wow.
Net income. Even bigger jump percentage-wise, up 264.5% to $27.7 million.
Okay.
And their adjusted EBIT, another key metric, that rose almost 49%. And earnings per share, $0.28, up 460%.
460%. Those are some dramatic improvements for the quarter.
Across the board, yeah. Really strong end to the year from a profitability standpoint.
Okay, so Q4 paints a really positive picture. But stepping back, you said the full year revenue growth was much slower, just over 1%. How do those square up?
Yeah, exactly. Full year revenue up 1.1%.
Yeah.
But even with that slower top-line growth over the whole year, profitability still moved in the right direction.
How so?
Well, operating income for the full fiscal year was up nearly 32% to $164.1 million. Gross margin for the year also ticked up to 69.9% from 68.8%. Still an improvement. Still an improvement, yeah. And net income attributable to shareholders, that rose too. $94.8 million for the year, which is $2.97 per share. That compares to about $58 million or 0.57 per share the year before.
So profitable growth, even if the overall sales growth was modest for the year.
That's right. And another really key point from the full year results.
What's that?
Their debt. They significantly reduced their net debt, cut it by over $175 million.
Okay, where does that leave them?
Leaves them with net debt of about $409 million.
Yeah.
Cutting debt by that much It's a big deal. It, reduces interest burden, gives them way more financial flexibility.
More room to maneuver, whether investing or facing economic bumps.
Exactly. Strengthens the balance sheet considerably, gives them more options.
Okay, so we've established DTC is firing on all cylinders. What about the other side of the coin? Their wholesale business, selling through other retailers.
Yeah, well, as you might expect with the DTC focus, wholesale saw a decline. It was down 23.2% in Q4.
23%, that's steep.
It is. They attributed it mostly to lower planned orders, particularly in Europe, Middle East, and Africa,
Yeah.
EMEA, and also some shipment timing stuff.
But it fits the strategy, right? Prioritizing their own channels.
It absolutely aligns with their stated strategy. And for the full year, wholesale was down 16.5%. So, yeah, definitely a deliberate shift happening there.
Okay, that makes sense strategically. Now, geographically, where did the growth come from in Q4?
The standout region was Asia Pacific. Revenue there grew 15.2%,
Driven by China.
driven significantly by Greater China, yes. North America also had pretty healthy growth, 8.2% overall. And interestingly, the U.S. actually grew faster than Canada within North America.
Okay. And EME, you mentioned lower wholesale orders there.
Right, so EMEA saw a decline overall, down 14.8% in Q4, and that was primarily linked to that drop in wholesale revenue we just talked about.
Got it. And are they still opening new stores, expanding that footprint?
They are. They ended the fiscal year with 74 stores globally. So
Yeah.
continued expansion of their physical retail presence as well.
It really sounds like a laser focus on their own channels, their own customer experience.
I think that's exactly right. And the report actually detailed some of the initiatives behind that. They talk about luxury retail execution.
Okay, what does that involve?
Things like optimizing staffing in the stores, making sure the right products are available, better training for
The
employees.
nuts and bolts of running good stores?
Pretty much. Plus the actual footprint expansion, opening new permanent stores, converting some temporary ones, it's all geared towards elevating that in-store experience.
And what about the brand itself? You mentioned the Snow Goose campaign earlier.
Yeah, they're really pushing that. The collaboration with Hader Ackerman on Snow Goose, they presented that as a big success in sort of boosting brand momentum and perception.
Injecting some high fashion energy.
Seems like it. They also mentioned a successful Lunar New Year campaign and working more closely with, high-end wholesale partners like Selfridges and Galleries Lafayette, even while reducing overall wholesale.
So being more selective there.
Exactly. Oh, and a big one. They launched their eyewear collection in Q4.
Eyewear. So branching out beyond apparel?
Yep, diversifying the product mix. That's a significant step into a new category for them.
Interesting. Okay, beyond the sales and marketing, any other operational highlights? We talked about inventory.
Right, that 14% inventory reduction over 6 quarters is probably the key one. It really suggests they've gotten much better at forecasting demand and managing their supply chain.
Which should help margins too, right? Less risk of markdowns.
Absolutely. Less carrying cost, less markdown risk, crucial for a luxury brand. And this ties in with the debt reduction and, a general focus on cost management, even while they're investing in things like marketing and upgrading their stores.
So becoming leaner, more efficient overall.
That seems to be the picture they're painting. More strategically focused, more efficient.
All right, so looking forward now to fiscal year 2026. What are they saying their main priorities are? Where's the focus for growth?
They outline 4 main areas. First is what they call building brand heat.
The brand heat. Okay. How?
Through more marketing spend, basically.
Mm-hmm.
But focused, high-impact campaigns, collaborations, telling premium stories around the brand.
Got it. What's number 2?
Second is expanding product offering, trying to be more relevant all year round, not just winter parkas.
Makes sense. How are they doing that?
Growing apparel beyond outerwear, refining how they approach these new adjacent categories like the eyewear we mentioned, and also really focusing in on their best-selling core products, what they call their hero SKUs.
Hero SKUs. So doubling down on what works best.
Exactly. Maximize the potential of their winners while carefully expanding. Third priority is driving business expansion. Developing their channels strategically. So expanding and improving their own stores, sharpening that retail execution we talked about, and also elevating the remaining wholesale partnerships.
Okay. And the last one.
Finally, just operating efficiently. Building a more flexible organization, improving production planning and supply chain further, and investing in their product and merchandising teams.
Sounds like a pretty comprehensive plan. Covers brand, product, channels, and operations.
It does. It touches pretty much all aspects of the business.
Now, every company faces, good things and bad things on the horizon. Opportunities and risks. What did Canada Goose point out there?
Well, on the opportunity side, they see, naturally, more growth potential in DTC, uh, continuing to elevate the brand's luxury positioning,
Right.
expanding into those new categories successfully, growth internationally, especially pointing towards Asia Pacific,
Mhm.
and just reaping the benefits of being more operationally efficient, better margins, better retail productivity.
Makes sense. And the potential clouds on the horizon, the risks.
They identify the usual suspects, really. Macroeconomic uncertainty.
Yeah.
Will people keep spending on luxury if things get tight?
Always a concern.
Geopolitical tensions impacting trade. Competition, which is always fierce in luxury apparel. The seasonality of their core products is still a factor.
The winter dependency.
Yeah. Currency fluctuations, that's always there for a global company. And just, execution risk. Can they successfully launch and grow these new categories like eyewear without stumbling?
Okay, so a mix of external factors and internal execution challenges.
Pretty standard list for a company in their position, I'd say.
All right. So as we kind of wrap up this deep dive into the earnings, what are the main takeaways for you? Summing up Canada Goose's position right now.
I think the big story is that strong Q4 finish, really powered by their own DTC channel, leading to that impressive margin expansion.
Yeah, the profitability jump was striking.
It was. And their strategic moves, like the Snow Goose campaign, especially that consistent inventory reduction, they seem to be working. Plus, the balance sheet looks healthier with less debt.
But it's not all smooth sailing.
No, definitely not. Areas to watch are how they manage that declining wholesale channel. Navigating those potential economic headwinds is key. And that big strategic challenge, achieving true year-round relevance for the brand.
Especially in places like EMEA, where they saw weakness.
Exactly. And managing currency impacts, too. So strong momentum in key areas, but definite challenges still ahead.
This has been really helpful. I think getting under the hood of those results gives us a much clearer view of their strategy and, where the focus is.
Yeah, you can really see the emphasis on that direct consumer connection, the brand building, and now this push into new product areas like eyewear.
Definitely. And it leaves you, the listener, with some things to think about, right?
For sure. Like, how well can they really make that DTC strength compensate for the shrinking wholesale business? Is it enough?
And what about eyewear? Will that move the needle long-term for the business and the brand? Or is it just a distraction?
Crucial questions as you follow the story.
Absolutely. And maybe one final thought to leave you with. In this economic climate, which is, let's face it, a bit uncertain, how does Canada Goose strike that balance between protecting its premium luxury image and needing to broaden its appeal to sell products year-round?
That's the tightrope they have to walk. It's a fascinating challenge.
It really is. A story definitely worth watching. Thanks for diving deep with us today on Stock Talk.